So welcome to the Quant University guest lecture series, everyone. Today is March 22nd. Happy spring to everybody. We are already in March, the end of March, and I hope you've had a wonderful Q1. And we have continued the tradition of education in the last 2 years. We have had meetings more or less every week, and we have had the pleasure of welcoming academics, researchers, practitioners, to talk about the research and the work they have been doing in various fields. And in the last 2 years or so, we have discussed various topics in artificial intelligence, machine learning, model risk, explainability, security, and various themes which are becoming more and more important as we kind of think about productionizing machine learning in the enterprise. And in that realm, I'm very pleased to welcome Ben Steiner, who is a good friend, a collaborator for many years, and someone who really knows model risk and causality. So I would really appreciate all your questions today so that Ben and I can have a discussion and make sure that we are kind of helping you understand the world of causality. As you know, Quant University has been working on various programs to make sure that the various topics we've been discussing is pragmatic and something which you can use in your day-to-day work. In that pursuit, we have partnered with various organizations like Premier, and we offer various certificate and other courses. We just kicked off an artificial intelligence risk management certificate program in the last month or so in partnership with Premier, and we've been offering various courses in this area. So if these courses are of interest for you and you've been thinking about upskilling yourselves in the area of machine learning and AI, responsible machine learning and AI, please check out quantuniversity.com, wherein we have a listing of the various courses we offer. We intend to continue enhancing the program and also getting feedback from you all so that we can build programs of interest to the practitioner community. We've been focusing on finance and insurance areas, but if you have other interests in the context of either practical applications or specific topics, please send us a note and we would be happy to consider it as we build out our programming. Also, if you have guest speakers in mind, or if you have speakers who you think would be of interest to join the Quant University guest lecture series, please make sure that you send us a note so that we can interact and bring them onto the platform. So without further ado, I would like to welcome Ben Steiner. So Ben, can you share your screen now? I'm just going to stop sharing my screen for a second. And Ben and I got to know each other through our MathWorks days, and we have interacted multiple times. And more or less, we continue the conversation on probably every other day. You know, we keep talking about various aspects of machine learning and artificial intelligence. As I have kind of learned from Ben, so he's a man of diverse interests, and also he understands things and can explain things in a really easy and understandable way. And one of the things I appreciate about Ben is, though he knows so much and he has held positions at various organizations and currently leads efforts at causaLens in the area of asset management and financial services, but he's also worked at various roles as a quantitative researcher, portfolio manager, head of model development, and chief of staff roles at various hedge funds and asset managers. And he also teaches a course at Columbia University, and it's in applied modeling. And all the students, I believe, are in good hands, understanding not only the theory, but also the pragmatic aspects. And he also serves on the board of directors of the Society of Quantitative Analysts. Before I hand over the stage to Ben, I want to start asking a question about why. You know, that's a question which drives everyone. We have this pursuit of search for meaning, the search for meaning for what happens to us. And I grew up in India, where in the Eastern philosophy is about karma. And everything has a cause, and whatever happens is because something you did in the past. So I've kind of ingrained myself in this philosophy of whatever happens, happens for a reason. And I'm trying to connect the dots there in the realm of artificial intelligence. And how can we make models also kind of think about relationships, and how can we explain, how can we predict, how can we build in these causal relationships formally. So in my pursuit of search for meaning, I want to kind of think about the philosophical aspects of it as we discuss today, Ben, and I will let you do the technical and the theoretical aspects of it, and I'll try to connect the dots from a philosophical perspective later. But all kidding aside, I'll hand over the stage to you, and welcome, and the stage is yours.
Sri, thank you very much for that very, very kind and warm introduction. I'm a big fan of what you're doing here at Quant University and the mission to share quant knowledge. And I feel I'm in very, I feel humbled in the esteemed company of the other speakers that you've had at Quant University. So I'm just great to sort of be around, be considered that level. So thank you for the invite. And you mentioned MATLAB. I can't let it pass without acknowledging Steve Wilcoxon's on the call today. We've all moved on to areas new, but my adventures with MATLAB started, I don't know, 25 years ago, back with Steve. For those of you I've not met before, as Sri said, my name is Ben Steiner. I've been a portfolio manager, a quant researcher. I've led a model development team at various asset managers and quant hedge funds. I also teach at Columbia because I love simplifying complicated topics, and that's hopefully what I'll do today. My role at causaLens is to help our asset management partners use these tools that are very, very exciting. But my purpose today is to share what is Causal AI. I saw some of the questions. What is Causal AI? How does it differ from Bayesian networks? How is it used in asset management? Hopefully I'll touch on all of those. So if I go to the agenda slide, what I want to talk about today is, what is the causal revolution? I'll say a few words of introduction, and then I can't come and speak to Sri without talking about model risk. So I'm going to introduce this via model risk, and I'll sort of use a model risk lens to describe why causal AI is so important. I'll talk about three problems: correlation and causation, linear modeling in a nonlinear world, and a world that changes over time, which are three very real problems we have in finance. And then talk about the solutions and what is causal AI and where it comes from, specifically with causal graphs and structural causal models. And then at the end, we'll show some examples of asset management through a causal lens. If you have questions as we go, please type them in the chat as you think of them. And if I see them, I'll try and take them. Otherwise, we'll wrap them up at the end. Here's the marking slide that my marking colleagues make me show. So what is the causal revolution? So look, a number of people who are far, far smarter than me and Sri have been saying that the causal area is the area to watch. And causal AI is going to be the next big breakthrough for artificial intelligence. So people like Judea Pearl, Gary Marcus, Yoshua Bengio, and so on. That's been going on for quite a while. And then last November, it's being recognized in the public space as well. The Nobel Prize Committee awarded the Economics Prize in honor of the Swedish Central Bank to two professors for their contributions to the analysis of causal relationships. And why? Why is everyone getting so excited about causal AI, and what is the potential attraction? Well, it basically is threefold. It deals with problems that are dynamic, and the solution is explainable and it's fair. Now, of the first two of those, of those three, the first two are very, very important to us in asset management. So dynamic, what drives our models, what drives our markets definitely changes over time. And unfortunately for us, the traditional statistical methods that historically have been sort of the backbone were designed for systems that perhaps didn't change, or were dealing with systems that did change, but in a suboptimal way. And as we know, the factors driving markets most certainly do change over time. Explainable. Well, one of the largest impediments of AI implementation can be the challenge of explainability. I remember in years gone by when I used to be asked, why does my portfolio hold this specific asset? My standard response was, well, it's because of the off-diagonal covariance elements. That explanation is true, but it's not great. It is an accurate explanation, but it's not a very useful one for the person receiving that information. Or my other favorite one, when someone would say, why is our portfolio down this month? My stock reply was always, well, because our longs went down and our shorts went up more than the other way around. It was true, but it didn't really give the person who's asking me the question much to work with. So causal AI can bring much more useful insights in terms of explanation. The last one, fair, I'm not going to spend too much on, but certainly for my colleagues working in the banking sector, this is about detecting and auvoiding bias in lending and hiring and so on. Less relevant for asset management, but is one of the big attractions of causal AI. That's why so many people are getting excited about causality for general artificial intelligence or artificial general intelligence. Specifically, I'm more interested in deploying it to asset management challenges today. We have a bunch of clients already using it, a number of asset management and trading firms. These are the ones we can publicize. But what are they using it for? Well, a number of things, a number of practical tools that I'll hopefully show at the end of today's session. Here's a few of the use cases we're seeing in asset management, and I'll go through some of them in a while. But before we do that, let's talk about what we mean by causal AI and sort of give the definitional stuff. So let's start with an example. I'm a big believer that rather than talking in theory, let's give a practical example. Let's say we've been collecting data on the frequency of shark attacks and how many ice creams have been sold in a beach town every month. And obviously, those two variables are correlated, shark attacks and ice cream sales. Now, traditional machine learning, what I've called here correlation machine learning, will find this association between ice creams and shark attacks and make a model to predict one from the other. Now, are ice cream sales driven by shark attack frequency? Or are shark attacks driven by ice cream sales volume? Well, of course, neither are true. And really, we need models that dig deeper. To Shree's point, we need models that ask why. Shree said that, and Udaya Pearl said that as well. You know, why? And the models need to answer the question why. Now, shark attacks might be based on all sorts of things. They might be based on wind patterns. Maybe the wind direction blows the sharks into the beach or away from the beach. Ice cream sales might be based also on demand for replacement products like frozen yogurt. So there's a lot more going on here than just this association or correlation. And what about sunlight or temperature or season? That's obviously the big one. So let me introduce the concept called a confounder. Now, something that drives both shark attacks and ice creams, in this case, sunlight, is called a confounder. And a big part of causal AI is about identifying and distinguishing between confounders and true causal drivers. So that to address the first question, what is causal AI? A large part, not all of it, but a large part of it is actually identifying those confounders. Let me give another example. It's called Simpson's paradox. And if we're relying just on correlation or association, then we can come to the wrong conclusion. That's a bad thing if we're trying to predict stock returns or stock volatilities or risk or return. And so, but before getting into asset management, let's look at some simple examples. Let's say we're trying to understand the relationship between cholesterol and exercise. We want people to be healthier. We want to lower cholesterol. So we collect data from lots of people and we plot this top chart here. And we see that as people do more exercise, they have more cholesterol. So there's a positive correlation there. However, age plays a critical role. And young people have less cholesterol and do less exercise. And older people have more cholesterol and do more exercise. So if we control for age, and when I say control for age, what I mean is put them into a bucket and plot them in the bucket. So if we plot the buckets of age individually, then we see the opposite relationship, the negative relationship that we accept, exercise lowers cholesterol. And so now we've got lots of negative relationships. And here in this example, age is the confounder. But if we didn't know about age, and if our model didn't anticipate age being a confounder, we'd have made the wrong conclusion that we could reduce cholesterol by reducing exercise, when in fact, at each age, we can reduce cholesterol by increasing exercise. That's called Simpson's paradox. It's why it's important to understand the structural nature of a model. And just incidentally, some people were doing that recently with vaccine data. But unfortunately, trying to explain Simpson's paradox to people who get their medical advice on Facebook is probably a lost cause. But some of the controversies around vaccine hesitancy was all about Simpson's paradox. Causal AI allows us to do a number of very, very desirable things. And this is the preview of what's coming up. We can build explainable models because literally we can see them as graphs. We can build more stable, more robust, more reliable models that don't get hung up by confounders or confused by spurious correlations. And we do this basically in two ways. One is using data in a smarter way. Quite simply, the maths and the statistics has changed since when I was in school. There's now a new language to express causality that's well, new, a couple of decades old. And the second way is we can introduce human knowledge more efficiently. So it's a much more easier interface for the humans to impose their domain knowledge into the model, so the machine and the model work together. As an aside, this also helps bridge the traditional communication gap between quants and our less discretionary, or sorry, our more discretionary colleagues. In the old days, we had the quants over here talking about root mean squared errors and large samples and covariances. And we had discretionary managers over here talking about the markets yesterday, today, and tomorrow. And there was sometimes a bit of a communication gap. Well, now the mathematicians can turn their formulas into a causal graph, and the discretionary managers can turn their talking into a causal graph, and they can both meet in the middle, which is quite powerful. So for a machine learning model to accurately model a system, there has to be a pattern there to be found, obviously, and that pattern has to be discovered. But discovering a pattern where none exists is overfitting, and we need to avoid overfitting. We really want to only discover the true causal drivers. That's where Causal AI can help. Secondly, correlation-based ML works by finding patterns in data, essentially curve fitting. That's what it's designed to do. And that's okay, just to be clear, if our system never changes or our system only changes slowly and the future is just like the past, that's fine. But if it's not, we need better models that are more dynamic and can understand cause and effect. And finally, in terms of explainability, traditional correlation-based models that are best at fitting the data are also the worst when it comes to explaining themselves. So historically, there was the perception there was a trade-off, but that need not be the case, and Causal AI can create inherently explainable models ex ante. On that last point, this is that trade-off, the old, I mean, I think people now have moved on from this, but at one point this was considered you could either have explainable or you could have accuracy, but you can't have both. Now Causal AI is certainly one of the solutions to offer both. Let's see how I'm doing for time. Oh, I'm running late. Why models? Model risk. Why models go? As I mentioned, I've got to talk a bit about model risk because I'm at Quant University and it's an area Shri and I know and love. So listen, the first fundamental mistake of an asset manager is not having a model and just behaving non-systematically. Unfortunately, the second fundamental mistake is following that model fanatically and not understanding the model weaknesses or when not to believe the model. As George Box once said, all models are wrong, some are useful. Model risk is about helping us understand how wrong a model might be. There's three different ways, at least, that a model can be bad: process risk, parameter risk, and model misspecification risk. What do I mean by those? Well, process risk is the fact that the real world is random. The real world is variable. We make a prediction, then the real world happens, and there'll be some difference. How different it is that process risk, and that's inherent in every model. Second one, parameter risk. The parameters of a model are not known with a crystal ball. We need to estimate them from training data. If we don't have the correct parameters, well, that's parameter risk. But it's the third one that I want to focus on, the model misspecification risk. This is the idea that the structure of an equation of a model is an assumption, and we might have the wrong one. And building models using measures of association like correlation is basically part of model misspecification. So my assertion is that our choice as modelers to build models using correlation and or association, that can be a model misspecification risk if correlation isn't all it's cracked up to be. So keep that in mind as we go through this. And let's talk about some of the problems of asset management or in general. The first one is correlation and causation. I'm sure everyone's heard of that one. Second one is linear modeling. Well, the world isn't linear. And the third one is the time-varying nature of capital markets. So let's talk about correlation first. I rather like this. Of course, everyone knows correlation is not causation, but that's the problem, because sometimes it is. The real problem is knowing when it is and when it isn't. So of all the correlated things, only a small part of them are causal. So in this picture on the left, the seagull sitting on the fence did not break the fence. In that case, correlation is not causation, but sometimes correlation is. Think about it this way. Of all the correlated factors in a model in the red circle, only some of them are the true causal drivers. There's the subset of true causal drivers. And in addition to the ones we found, there might be others that we don't know about, yet. And causaLens exists to differentiate the causal factors from the correlated factors and then discover additional causal factors. That's basically our reason d'etre. So why might there be correlated factors that are not causal? So we measure X and Y, there's a correlation between them. We build a model of Y using X as the independent variable. But which one of these 5 situations do we really face? In the first one, X causes Y. That's the true situation. Great. We want a model of Y on X. Brilliant. However, unfortunately, if we get the causality the wrong way around, correlation won't tell us that. So we've got the wrong way around. In the third situation, we've got a confounder. So we've got a situation where X and Y look correlated, but actually they both depend on C. So building a model of Y on X isn't really going to help us because Y and X are not truly causal of each other. In the fourth example, we've got a spurious correlation. We've got an association by chance. We've got a finite sample size, so we think there's a correlation there in our sample, but that artifact has just appeared by random. So don't build a model of Y on X. And in our final example, we've got a third variable M that is what we call a mediator. So X is driving M is driving Y. There's noise between X and M. There's noise between M and Y. If we build a model of X on Y, we could do that, but there's now 2 sources of noise. We would be better off building a model of Y on M directly. So if we know M exists, let's use M. So that's 5 examples where only one of them is correct, but they'll all look the same when it comes to correlation. Now let's talk about the second side, the fact that correlation fails to capture non-linear relationships. I'm sure some of you have seen this image before. There are lots of data sets where the correlation is the same in each case to 2 decimal places, but obviously there's relationships there that are not captured. So we've got 2 problems. Correlation and causation are different. We want to build models with only true causal drivers. Correlation only captures linear relationships. This can limit our model. The third one I'm going to go through very quickly because I'm running out of time, but this is the idea there's time varying in financial markets, and we move between regimes we know and regimes we don't know. We can move between them in different ways. That's the idea of concept drift. The thing that we're modeling is not stable. Drivers change. And in the real world, these all happen at the same time. So now we've got 3 problems. We've got correlation and causation are different. Correlation only captures linear relationships. And the world is changing over time as well. So our out of sample is going to be moving away from our training sample. So what can we do about this? Well, it all comes down to causal graphs and structural causal models. So let's talk about what a causal graph is. A causal graph is just a combination of those simple charts I showed earlier. So X and Y being unrelated, Y driving X, X driving Y, X driving M driving Y, or X1 and X2 both driving Y. This last one down here we call a collider, when there's 2 things driving the same output. We're just going to build up graphs from these very simple relationships. So on the right-hand side, we've now got an example of a larger causal graph of how individual equities are related to each other. E.g., this is the returns from all 500 stocks in the S&P 500 over the last month. And this would be a more realistic causal graph. And what does a causal graph show? Well, at its simplest, it's a way to visualize a mathematical model. The nodes in the graph are our variables, both our inputs and our outputs, or as the statisticians used to call them, the independent and the dependent, or simply the left-hand and the right-hand side of the equation, for those of you old enough to call it statistics. The edges are directed, which means there's a direction to them. They point in the direction of one variable causing another variable. Here, y is the output, and x1 and x5 might be potential drivers of y, because they might be correlated with y. However, y is a function of only x3 and x4 directly. So y may well be correlated with x5, but it's not caused by x5. It's caused by x3 and x4 directly. And we call this a directed acyclic graph. Directed because there's arrows, acyclic because the edges don't go back on themselves. It's very visual, it's very intuitive. It creates a language to understand causal relationships. Take this one step further. Now let's talk about the models themselves. So more formally, say we have three variables, x, y, and z. And x is a driver of y, and y is a driver of z. In addition, there's other things that cause x, y, and z. Let's call all those other things ux, uy, and uz. So this is the set of other stuff. This is the set of exogenous stuff outside our model. And they're independent between each other. So there's no edges between ux, uy, and uz. And let's group x, y, and z. Let's call them the endogenous variables. They're the ones inside our model. And let's call them v. So u is the set of exogenous, v is the set of endogenous, and then f is the set of functions that relate all the endogenous variables together. So f of x is a function of u of x. F of y is a function of x and u of y. And f of z is a function of y and u of z. So the set f functions are now the mathematical equations, or the edges. It's the functional form of the edges of the causal graph. So the key point here is that the DAG on the left-hand side just shows us almost direction. The structural causal model adds the equations and the functional forms to the edges and fully specifies how everything is related to each other. But they're both ways to represent causal relationships in a system. So there's three approaches to do causal inference. The first way is to do experiments. We can actually intervene on our x and see what happens to our y. And the gold standard there is a randomized controlled trial, medical controlled trials and things. But that's not always possible. It might be unethical. It's too expensive. In finance, we can't do it. We can't run the economy a second time. We can't try the economy once and change something else and try it again, or change this stock and see what would happen. So the first one doesn't work for finance, but the maths that came from the first one can get applied to the second one. So the second one is working with observational data. So working with the data we've got, we can perform what's called causal discovery to statistically tease out what the causal relationships are. And it goes far beyond just looking for association. And the third area is domain knowledge. So how we bring in expert opinion, how we bring in views into the model. And if there's a feedback loop between 2 and 3, and they're happening iteratively, we call that human in the loop. And that's basically when there's a dialogue between the algorithms and the humans to iterate incrementally to a better model. And this is the bit where causaLens, or the bit of causaLens that I'm involved in, is focused here. We have other areas working on this, but that's not in finance. I'm looking at the time. I'm going to spend a quick word on this. I'm not going to go through in detail. Basically, Judea Pearl came up with a thing called do calculus. The left-hand side is almost old-fashioned statistics. which is the statistics that I learned in school, which is factorization of joint probabilities. But this doesn't help us understand if X creates what, if X causes Y or Y causes X. So one of the challenges of this work a few decades ago was we didn't have the mathematical language to talk about causality. But now we do. Now it's called do calculus, and it's a way to express the difference between X causing Y versus Y causing X. And these are the two expressions here. I've run through that much faster than I wanted to because I want to get to some of the examples at the end. As I said, in investing, we typically can't intervene, but the maths that Pearl developed and others around interventions can be applied to the observational data that we have. And it's parts 2 and 3 that we talk about. Okay, let's talk about where we are in terms of current states and existing approaches to causal AI. It's kind of a big deal. A lot of people are working on this. A lot of companies are doing a lot of research, a lot of publications are coming out. This is the chart of the publications at NeurIPS that were on causal papers. It looks impressive. And then it's even more impressive. You realize this chart ends in 2020. Last year, 2021, it'll be off the chart somewhere up here. The popular themes at 21 were causal discovery, causal reinforcement learning, fairness and bias, latent confounders, partial observability, and so on. So there's a lot of active work on this right now. In terms of what causaLens is publishing on, we've done a lot of work assessing what other people have done. And so evaluating the public and the open source packages, working on data generation, putting together overviews of other methodologies. We've then looked at counterfactuals and explanation. A counterfactual is if something happened that's never happened before. So can the model deal with data it's never seen before? The what if, data that's beyond the training data. In various different industries, the image recognition area is the occluded images. And then one of the questions was around Bayesian networks and structural causal models. It's probably a good time to bring it up now. I did take the liberty when that question got asked of firing up one of the papers. So the question on Bayesian networks versus structural causal models, essentially they're both graphical, and essentially they're both allowing expert knowledge to come into them. One of the big differences between Bayesian networks and structural causal models, a Bayesian network starts with a prior, and the prior eventually gets ignored once you've collected enough data. So when you start, you know nothing of your Bayesian priors, then as data comes in, as the learning happens, the prior gets down-weighted and the data becomes supreme. That does not happen in structural causal models. So you don't lose the human involvement. The human prior stays there is one area. The other area is that a system can have many Bayesian networks, whereas there's only one true structural causal model. So the Bayesian networks don't explain causality in the same way that a structural causal model would. And because of that, basically the arrow in a Bayesian network doesn't mean causal, whereas the arrow in a structural causal model does. And because of that third one here, all of these then don't happen for a Bayesian network. And then the only other thing I would say there is the father or one of the leading lights in Bayesian networks in the 1980s was Judea Pearl. Judea Pearl, when he sort of finished with Bayesian networks, sort of had the aha moment and started thinking about causality. Happy to share this paper if anyone's interested. And then a lot about fairness as well. On the regulatory side, on the banking side, there's a big push on fairness and bias and so on. I think causal approaches have a huge role there. So now let's get to the fun part. Or maybe I'll pause there, look at the questions, and then I'll go through the asset management stuff.
So there are a couple of questions, Ben. First of all, what makes a model causal? I mean, is the model going to have a tag saying this is a causal model and this is a regular model? Or causality assessment is a part of a process wherein you build whatever models you build, and then you do an assessment, or you do a pre-assessment on what data relationships are you looking at, and then factor that to build models? I probably add a little more to what John was asking, but just to give a little bit of, I mean, I want to understand it.
Yeah, that's a great question. It's not an after the fact thing. It's not a sort of, it's not a, this model is causal and there's a test, yes or no. It's baked into the development pipeline. There's signal processing, which identifies potential features, potential factors, and so on. Then of all the correlated factors that exist, the key feature is only using those features that are causal. So using a much smaller set. And then a causal model in and of itself has to be able to do certain things, which is it has to be able to explain. I guess maybe I've contradicted myself now, because you can, if it can handle certain things like counterfactuals, if it can imagine, if it can accurately deal with a situation it's never seen before, that's the type of thing a causal model needs to be able to do. If it can answer why did the output, why is it the way it is? That's another one of the features. There's probably a number of criteria as well. So it's less of a mathematical test. It's more of a series of criteria. But the key amongst those is that there's a directed acyclic graph, which means that you can trace back what's happening. That's one of the fundamental attributes. And the fact there's a structural causal model means that not only can you trace back, but you can make predictions if things were to change. So if one of my nodes, the value change, it's very clear what the output is going to change to.
And this is just a structuring question. So when you look at cross-sectional data sets, wherein you have a bunch of features, and temporal data sets, wherein there is a sequence of events which have happened over time, right? So how do you kind of think about causality when you're thinking about cross-sectional data sets wherein you're looking at attributes, you don't have any kind of time-related assumptions, but those features may be correlated, but certain features may have been caused to take certain manifestations of values because of some other feature. So just kind of trying to structure the problem on how do you structure causality assessments for cross-sectional data problems, and how do you look at it from a temporal series if you're looking at both univariate and multivariate time series?
The cross-sectional one's obviously easier. The cross-sectional one, certainly in finance, lots of data points, not changing, fine, done. So I'll put that on one side. The time series one, I think, is the more exciting one to talk about. So the time series one is, obviously, if it's a world that never changes, the time dimension doesn't matter. In the real world, the world changes and the drivers themselves change. So the question then is, how quickly are the drivers changing versus how quickly can data be collected to recalibrate a model, with what type of model monitoring is going on. So a model that changes very, very, very quickly, that you can't collect enough data for, you can't really do much about. A model that changes very, very slowly, that you can collect lots of data, you can do a lot about. But the sweet spot's somewhere in the middle. Maybe I'll actually bounce back to one of my slides I skipped over. Here we go.
That'd be great slides.
So consider two extremes. One of them has zero concept drift. The other one's a random system. At zero concept drift, AutoML and lots of data knock yourself out. I mean, job done. You don't need causality there. Random system, no pattern, you can't learn anything. But the fun is in the middle, where there's some concept drift and we can collect some data that can be used. So the question then is, are we using causal discovery domain expertise, i.e. the humans, or are we using more causal discovery statistical algorithms, or is it a combination of the two? So the more data we have, the human can get involved optionally or not. The less data we have, the more the human needs to be involved. So it's basically different problems have different uses of that. Some of our clients are high frequency market makers. They have bucket loads of data. The humans really are not getting involved. Some of our clients have quarterly or annual data. there's some data, but there's not much. The humans are basically expressing their view on what the causal graph should be. And then there's everyone in between, where the data generates some of the answer, and then the humans sort of exercise their subjective opinion on top of that.
Mm-hmm. And maybe I'll ask one more question, and we can continue with the discussion. So how do you kind of look at causality as a driver? I mean, when you talked about high frequency trading shops or other clients who may be interested in, evaluating causality. I mean, when I learned my data science, many years ago, we didn't have a bucket wherein we would say, okay, we're going to do causality assessments. You look at correlations and like, oh, okay, let's just kind of, model it and, build stuff and move on, kind of a thing, right? So are people pausing, and why are they pausing to understand causality better? Is it that they want to kind of, get a better understanding of what's happening between the various features and then say, aha, I get it. This pursuit of search for meaning versus, I want to reduce uncertainty. I want to really understand what's actually happening so that I can make decisions better. Or is it more coming from, there's so much happening, I want to have additional drivers or additional tools so that I can understand the process better? So what's driving people towards causality assessments, and what's driving people towards understanding these relationships better?
I think that's a really good question. I think that there's a number of different things going on. So I think one of them is just, this thirst for innovation. The world we live in, people want the extra edge. People want the new things. I think there's definitely an element of that. I think also there's an acknowledgement that statistics almost took a wrong turn about 100 years ago and sort of drove itself into a back alley. When people were looking for the answer to causality, and like Galton and who else was it? The British Society back in the day in the 1800s, they basically sort of said, we're looking to prove causality. We can't, we invent regression instead. And then statistics evolved from regression through correlation to through just purely based on association. And we used the word correlation is not causation and almost brushed it off. And we just sort of almost didn't ask a better question. And then I think that attitude was pervasive for several decades or longer, longer than decades. And so now there's the reality is coming back that actually we can do better. We don't need to stop at just association. We can work with causal models. We can, what you described, people are doing causal analysis to evaluate their existing models, but we can go one step further, which is we can actually build causal models with causality baked in.
Mm-hmm. Mm-hmm. Cool. So let's continue the presentation, and I'll keep monitoring the questions, and we can spend maybe another 10 minutes.
Cool. Oh, my screen's just gone dead. And why is that over there?
No, we can see your screen. Yeah.
Oh, you can see my screen. Okay.
Yeah.
I've got the bar sort of on my screen, but I guess you can't see it. Okay. So a bunch of areas where we're already seeing this used in asset management. Here's a few of them. In terms of portfolio construction, well, causal models are more explainable. So the example I gave about just saying it's the off-diagonal of my covariance matrix, we can actually do better than that now. And actually we can find a higher risk-adjusted returns as well, but we don't make too big a deal out of that. On human-guided research, we can speed up research. We're combining both new algorithms and making it easier for humans to interact with those mathematical models. So we can now literally see models. And that can help with the historical communication challenges I described earlier. We can discover orthogonal features. So we can search for new orthogonal features that are causal. So we can improve our existing models, and we can evaluate alternative data sets and only onboard sort of the useful data in inverted commas. And there's a bunch of other areas as well. We can do performance attribution, where we're finding why we performed well, not just when we performed well. We can do nowcasting of macro variables, scenario analysis, stress testing, and so on. Let me show a few of these. In terms of portfolio construction, recall both Markowitz uses covariance matrices and hierarchical risk parity clusters on correlations. There's a correlation matrix at the core of both of them, and so they both risk overfitting. By using causal relationships, we can find more stable relationships and improve both approaches And actually, we do see higher out of sample generalizability. In terms of showing how that works, we can upload our risk factors. We can create a dendrogram. We can then create a little causal graph and play with it and look into it. And then in this case, it's graphical lasso, but we can discover the causal relationships between assets, equities in this case, and see which ones remain after the spurious correlations get taken away. And the most similar using this particular risk space get connected. And then the ones that are left behind, i.e. these ones down here, these are the ones that have idiosyncratic in this risk factor space. They've got no connections to anything else. As another example, this is our risk lab. We upload some factors, and then we can upload our portfolio returns. And then we can, oh, they're going to zoom in a little. Let me bring it a bit bigger. There we go. Oh, what I was trying to show was the Barrow risk factors that can be used to get a model. This particular one is an example of human-guided research. So this is where we've got now a multi-layered graph where different things are driving the particular target here. And the idea here is that the human can add nodes, take nodes away, change the connections, and impose their knowledge onto the graph itself. So by moving things around, a graph is generated with the data. The human then steps in, puts some constraints in place, generates another graph, the human steps in, and so on. The data and the humans can work together. The causal risk assessment.
Ben, can I ask you a question there?
Sure.
Is there a notion of validation in this process, or is it more coming from the perspective of exploration?
It depends on the use case. So if we're model building, the human is an inherent part of the model building process in some cases. So if it's purely statistical, it's purely statistical. If it's using quarterly data or annual data, the human input is a key component. So that's one of the key attractions, which is it's not purely a statistical model. It's the human interaction on that particular use case.
And is there a notion of persona in the human? For example, I mean, in explainability, like, you think about like, okay, here's an explainability for an end user, for a data scientist, for someone who's going to be building models. So is there a notion of what does it mean from a persona who's actually doing this analysis?
I'm sorry, I'm not quite clear of the question.
So I'm trying to understand, if someone does not have a statistical background and they're trying to understand how the model is, creating results. So will they see a different explanation or different ways of looking at things versus someone who really understands the statistical relationships and they're trying to figure out which parameter versus other parameter.
Got it.
Yeah.
I mean, I'll give you an answer that may or may not be the answer you're looking for, but it may help illustrate it. So what we as a product have is a data science platform. So we have a very, very horizontal platform designed for data scientists that they can do signal discovery, causal model generation, the full model research pipeline. But that's for data scientists. Not everyone touches our technology at that point. The high frequency traders, the execution people that work with, they don't use the platform. They just use an API and the technology behind it. So some people hit us through an API, some people hit us through a data science platform. And what I'm showing now are what we call decision apps, which are no code or low code ways to interact with the technology. So someone who doesn't have a statistics background doesn't need to be a data scientist. They literally can point and click. This is the evolution of low code, no code.
And sorry, I'm asking a lot of questions. I mean, this is fascinating. Probably you and I, we should have a 3-hour workshop on this. So how do you bring in context? I mean, that's our favorite word, right? Whenever we talk about things, we say, well, machine learning model, which does X, Y, Z, it's like, for what? Right? So, how do you bring in context? Because, you may have, as you were kind of giving the example, the beautiful pictures of the pigeon. I need to get that from one of my slides. When you look at that picture, it depends on the perspective, right? So, you're saying, okay, now you are focusing on the fence. The fence is broken, but someone who is like looking for a lost pigeon is probably looking at like, well, I see two pigeons, which one's mine? So it's a completely different perspective on how you look at problems, right? So how do you bring in context when you think about analysis?
The context comes down to what is the purpose of the model. So what is the purpose of the model? Why are we building a model? What is the business problem we're trying to solve? Is someone worried about a portfolio construction problem? Are they worried about a performance attribution problem? So the use of this technology fits in at multiple steps in a potential investment process. So, whether it's return forecasting, risk forecasting, portfolio construction, then sort of ongoing monitoring, or even performance attribution after the event, or risk management during the portfolio's lifetime. There's lots of different spots this can be brought into. This, let me, half a eye on the time. This, I think, might be more, the causal risk assessment might be more sort of the after the fact. There is a traditional model. Can we evaluate it for causality? So this is what we call model risk management or model validation. This is where, given a model or raw data, do a causal risk assessment to look for the causal drivers of performance for a model that might not be created with causal technology. We've done stress testing using macro factors, the CCAR, DFAST, fun and games that we all know and love. There's a relationship there, which is, well, we're building causal models. We're just not using causal graphs to build them. This allows the models themselves to be built point and click and with data discovery. We build a causal graph, and then we can use what we call counterfactuals, or what if, or what the regulators call stress testing scenarios to explore the impact on our bank. Causal boosting is basically using the residuals of a model and light gradient boosting machines to try and explain the residual further. I'll skip through that one. And this is just a return forecasting exercise. It basically allows us to hone in on different targets or different areas. To wrap up and then leave maybe the last few minutes for any last questions. This was just a very, very, very brief overview of some pretty groundbreaking work that many think will have a significant impact on like artificial general intelligence in like years and decades to come. But for asset management, it can help today. So to make decisions, we should consider different scenarios, answer what if questions, imagine about counterfactuals. And conventional machine learning purely learns from our data. It gets confused by spurious correlations, hidden confounders. We want to really know why happens because X happened. What conventional machine learning gives us is why happened when X happened. When being correlation, because being why or causal. We want to have ex-ante explainable models so we can trust them. We don't want to build a model and have to build a second model to explain the first model. We want the first model to be inherently explainable. And to do this, we can build directed acyclic graphs and structural causal models. The big picture, as I mentioned, is that a lot of big thinkers think causality is a necessary condition for general AI and the ability for machines to reason, and that's sort of in the future. But before that, there's a lot of things that are being helped in asset management that have bothered me over like a 25-year career in asset management, such as the past is no indication of future, but then we use past data, or correlation is not causation, but then we look at correlation matrices to try and explain things. So there's a lot of questions we can now ask that have bothered me over my career in asset management, including some of the ones that I tried to show very quickly. That's it. How long do we have left? 2 minutes?
Perfect. Yeah, thank you so much. So a couple of questions have come up. So first of all, how can data science and investment companies reliably predict security pricing, assuming that we are closer to predicting prices a few seconds from now versus a few days versus longer from now? Now, does causality assessments kind of help understand the time element when you're thinking about building causal graphs?
Let me answer it two ways. The first thing I'll say is, I think, to agree with the questioner that yes, predicting a few seconds ahead is an easier problem to solve than predicting 30 years ahead. So by definition, you know, the shorter the time frame, the more data we can collect, the more persistent the pattern there is, the less concept drift there might be. So I think I agree with that statement. What was the first part of the question?
So how close are data science and investment companies reliably predicting security pricing? I mean, it could be a very generic question.
Yeah, for some securities, I think it's very possible. For derivative securities, it's happening. Yeah, you don't need causal models for that.
I think it could potentially just be, with respect to specific securities. I mean, like there are so many types of securities, right? So
we see clients using our tools to do that. Maybe that's the most that I can say without being too specific. For confidentiality reasons. We certainly have clients trying to do that.
Perfect. So another question, this may be a little more technical. How can you know that the model has been misspecified?
I love this question. So basically, parameter risk, we can measure. Process risk, we can measure. You know, process risk is the standard error of our training data. It's the randomness that's in our training data. The parameter risk is the standard error of our coefficients in linear regression, you know, in a simple example. So we can get our hands around parameter risk and process risk. And misspecification risk was this sort of the model might be wrong. How do you know? The type of thing. Well, that's the point. You don't until you start seeing it go wrong. So I would equate very heavily model misspecification risk with mine and your favorite topic, Sri, model monitoring. Which is, you know, model specification risk is intricately tied to model monitoring. Is the model doing what it's intended to do? What are the early warning signals that will tell you the model might have been misspecified before it's been too bad? You know, obviously in trading strategies, investment strategies where I come from, you know we've got a bad model and we've lost a lot of money. But by that point, it's too late. The idea is that you have warning signs beforehand. So what are the typical things that go on in the model that you'd keep an eye on? Now, in my world, investment and trading strategies, it's, you know, how many trades is it generating? What's the average holding period? What's the volatility? What's the slippage you're incurring? So basically all the attributes that you'd have in your back test, if they start changing somewhat, something's changing. It may not have had an impact on P&L just yet, but it may do. So to answer that question, I would say misspecification risk is very much tied to model monitoring. And model monitoring is very much tied to having a good idea of what the model should be doing if it's behaving as intended, and then having the red lights go off as soon as it starts deviating. Yeah,
talking about red lights, where do you see, causality assessments becoming a part of the regulated process? Is it something which will be mandated versus model risk departments or people who are going to be approving models towards production saying, well, I need to understand these aspects before I can say this model is ready for production? Or will there be, rules similar to explainability? I mean, ethics and explainability and fairness and bias and all these concepts were predominantly in the academic realm many, many years ago. But now you're seeing them in frameworks and regulatory documents wherein there's requirements at times. So do you see causality and assessments on causal relationships being a part of the regulatory process? And
I can tell you what I'd like to happen versus what I think will happen. The pragmatic approach, the sensible approach, if we take the most common sense approaches, there's no such thing as a causality assessment. It's not separate to anything. In order to satisfy explainability, or in order to satisfy any bias assessments, or in order to, causality is a tool or a way of building models that can satisfy all those frameworks. So if you've built a causal model, you can demonstrate explainability. If you've built a causal model, you can demonstrate lack of bias. I didn't speak about bias because it's less involved in investment management, but sort of we can show various things, yes or no, and various tests. So I don't think there should be a separate regulatory piece as you must have a causal risk assessment, you must do this, this, and this. I think the most pragmatic approach is, when you get a carpenter to build your house, you don't tell him you must use a hammer, you must bang the nails into the walls. You say, build me a house. And the carpenter goes away and uses the right tools to bang the nails into the walls. So I would see this as a tool, and causal approaches as a tool, and causal models as a way of satisfying a lot of the other regulations that are already out there. Just to reassure any regulators on the call, I don't think we need more regulation.
Okay. Cool. That's probably good to hear, at least for the people who are like concerned about regulatory aspects. Okay, so I'm going to wear my, the final question is me becoming a student again. You know, as you know, I'm a lifetime student. I always invest a part of my, day, week, year learning before I can teach. So I'm a student. I have a month, and I'll be interested in spending 20 to 25 hours on learning all about causality. Where do I start? What should I be aiming at? And how do I go about learning more about causality?
Well, I'll show you our website. On our website, there's a big thing on resources, our Causal AI research section. So Judea Pearl sort of wrote the book called literally The Book of Why. It's a great introductory book. I'd read The Book of Why as a first step. I would, if you want to, we've got a lot of downloadable open source research, both industry focused, but also more theoretical. Browse around, have a look, ask questions. Cool.
And I hope people can reach out to you in case they have any questions about the demos you showed or any of the papers you shared.
Absolutely. I mean, if you want, I can give you some of the technical papers if you want to distribute to people.
Absolutely. So we will talk offline, and I will make the slides and the video of today's session, and also the papers which Ben is going to share to all the participants of today's workshop. So thank you everyone again, and thank you, Ben, for an enlightening session and sharing your immense knowledge. And also, I love the slides. I need to talk to your designer and how you could create all the slides. And I can potentially, hire them as an intern or something so that they can do some of our slides too. Maybe you can moonlight for us.
I was going to say, if you, that'll be me, the designer, then, if you want to.
Okay, so spend a couple of hours helping me with the slides then. Cool. So thanks again, Ben. This was a fascinating discussion. I learned a lot today. A couple of quick announcements for people who are planning to attend the next session. So next week, we have Kush Varshney from IBM, who has recently written a book called Trustworthy Machine Learning. So that's a fascinating book, and Kush has been at IBM leading various aspects of trustworthy AI related projects for many, many years. And he's graciously accepted the invitation to talk about trustworthy machine learning and AI governance. So if you're interested in kind of comprehensively looking at what does trustworthy AI mean, and Kush has also released a recent book. It's also available on Amazon. So we should talk about the book and also some of the contents there in the next session. A lot of learning. So March 29th at 12 p.m. Please bookmark. You're going to be sent out invites if you have signed up for the Quant University mailing list. But next week, we'll be talking about trustworthy machine learning and AI governance. So thanks again for attending today's session, and we will keep in touch. And thanks again, Ben, for all your time.
Thank you for what you do.
Thank you.